Okay, let's unpack this. We're diving into the latest PayPal Q3 2025 earnings report,
Yep, the numbers are out.
and they are generating some significant momentum.
Absolutely. Our mission today is, well, a quick but pretty comprehensive breakdown.
Right.
We need to understand not just what they reported, but, why the stock reaction was so sharp.
Mm-hmm.
And maybe most importantly, what this new forward guidance tells us about their strategy going forward.
Definitely. So the headline immediately grabbed attention because, well, the company delivered a pretty significant earnings beat.
Not across the board.
Yeah, non-GAAP earnings per share came in at, what was it, $1.34?
I'm $1.34, yeah. Crushing the $1.21 forecast.
That's a 10.74% positive surprise. Big beat.
And you saw that flow through to the top line, too. Total revenue hit $8.42 billion.
Also beating the $8.22 billion expectation.
A clean beat, yeah. About 2.4%.
So the market reaction, I mean, it was pretty predictable with that double beat, wouldn't you say?
Oh, absolutely. Following the announcement, the stock surged. What was it 8.48%?
Yeah, in pre-market. Pushing up towards, like, the high 70s, $76.21, I think.
Right. But, we always say the headline beat is often just surface level.
Sure.
What was the sort of underlying story here? What allowed them to surprise so strongly?
Good question. What are the fundamentals looking like?
Well, if you look at the health metrics, there's some pretty compelling evidence of, let's say, operational discipline. PayPal still has that good overall financial health score.
Okay.
But the really technical indicator that jumps out is their Piotrowski score. It's a perfect 9.
Okay, a 9 out of 9 Piotrowski score. That sounds very technical. For you listening, why should we care about that specific number? What's it actually measuring?
Right. So think of the Piotrowski score as like the company's report card across 9 different areas of financial stability and, importantly, efficiency.
Okay.
It looks at profitability, leverage, liquidity, operational efficiency. Getting a perfect 9 is actually quite rare.
Yeah.
It signals that basically every dollar the company brought in was managed with, extreme discipline. It feels like evidence that the new CEO's focus on streamlining is, well, translating into results.
But, given they operate in such a dynamic market and there are these macro headwinds we keep hearing about, does a perfect score maybe suggest they might be too efficient right now?
Ah, interesting point.
Like maybe underinvesting in growth while they're busy managing costs.
That's the critical question, isn't it? And the answer seems to be that the efficiency actually translated directly into profitable volume growth.
Okay.
So total payment volume, TPV, that increased a solid 8% year over year, hit $458 billion.
Right.
And crucially, we need to look at transaction margin dollars, TMO.
Okay, let's pause on that jargon for just a second. Most people track revenue, but you're focusing on TMO. Why is that the more meaningful metric here?
Right. So transaction margin dollars is basically the money left over after the company pays for all the transaction expenses.
Like fees and processing costs.
Yeah.
Exactly. Network fees, interchange, processing, all that. So it's really the purest measure of how profitable the transactions themselves are.
Got it.
And they reported TMO, excluding interest income, grew 7%.
Okay, 7% growth there.
So they're not just seeing volume growth. They're clearly prioritizing profitable volume growth. That 7% signals, quality over just quantity.
And this operational strength, it seems like it clearly fueled a major change in their outlook. This is where the narrative really shifted, I think.
Definitely.
They gave this massive update to their full-year guidance and signaled a whole new approach to capital allocation.
Yeah, this feels like the inflection point. Management raised their full-year guidance for non-GAAP EPS.
What's the new range?
It's $5.35 down to $5.39, which, projects pretty robust growth for the year, 15% to 16%.
Wow. And they also raised the TM year outlook too, right?
He did, to between $15.45 billion and $15.55 billion.
So this confidence in their underlying business, it wasn't just expressed through, raising the numbers. It was also in their shareholder commitments. Precisely. And this signals, I think, the maturity of the company. PayPal initiated its first ever quarterly cash dividend program.
First ever. Okay.
Setting the initial payout at $2.14 per share.
Mm-hmm.
And they're aiming for about a 10% payout ratio of their non-GAAP net income.
Why is initiating a dividend so important, symbolically speaking?
Well, it's a huge shift, isn't it? From being seen as purely a growth-at-all-cost stock to a company that recognizes its scale and its financial stability.
Right.
They're essentially telling the market, look, we generate so much free cash flow now, we can simultaneously fund our aggressive growth plans and return capital directly to you shareholders.
And they're pairing that new dividend with still continuing that aggressive share buyback program.
That's right. They're still on pace to complete roughly $6 billion in share repurchases for the full year 2025.
It's a pretty compelling commitment to capital return, all things considered.
And the CEO, Alex Chris, he explicitly tied this confidence back to strategic improvements. He said, PayPal is a fundamentally stronger company today than it was 2 years ago. Driven by this focus on faster, durable growth. And we're seeing the results of that focus now, particularly in accelerated growth in some key segments.
Okay, let's get a bit more granular on that acceleration then. Where exactly are they picking up speed? Is it balanced, or is it really driven by a few major anchors?
It seems to be driven by anchors, particularly in the U.S. market and with Venmo.
Venmo keeps coming up.
Yeah, Venmo TPV grew 14% in Q3, and that's an acceleration from 12% growth in Q2.
Okay, so picking up steam there.
That uptick signals real momentum, I think.
Mm-hmm.
Also, their branded experiences TPV, that grew 8% globally. But crucially, in the U.S. market, that growth actually accelerated to 10%.
So they're executing well where it matters most.
Seems like it.
Okay, let's shift now to the underlying growth drivers then, the specifics of how they're keeping this pace up. We probably have to start with buy now, pay later, BNPL. That story just seems to be getting massive.
It is massive scale, yeah. Especially for a feature that's kind of integrated into a legacy payment player like PayPal.
Right.
Both the TPV and the monthly active accounts in BNPL grew over 20%. They're projecting they'll process nearly $40 billion in BNPL TPV for 2025.
$40 billion. Wow. And the user satisfaction seems high, too.
Yeah, a Net Promoter Score, NPS, of 80. That's very high. Indicates users really like it.
Now, what I found fascinating in the materials was this strategic shift they mentioned, moving BNPL upstream in the presentment. What does that actually mean for someone like you or me shopping online?
Right, it's about meeting the consumer earlier in their kind of decision process. Historically, BNPL was an option presented right at the very end at checkout.
Yeah, after you've already decided to buy.
Exactly, often after you'd already mentally committed to the price. Now they're pushing it upstream, maybe to the product page itself, or even when you first add something to the shopping cart.
Okay, so instead of finding out I can split the payment at the very last step, the option to pay over time might influence my initial decision to even click Add to Cart.
Precisely. It changes the whole dynamic. It shifts from just being a payment method to being more of a shopping incentive.
Interesting.
And their internal testing seems to prove this works. They're seeing almost a 10% lift in their branded checkout volume when those BNPL options are shown earlier.
A 10% lift. That's huge.
It's huge at their scale, yeah.
Oh.
It basically makes the payment option itself a key tool for customer acquisition and conversion.
That's a really profound behavioral trigger they're tapping into. Okay, let's move to Venmo then, which, as you said, remains this massive source of potential. Monthly active accounts grew 7% year over year.
To almost 66 million users.
66 million.
And Venmo revenue, it's on pace to generate about $1.7 billion this year. That's up over 20%.
So the core P2P network effect is clearly healthy.
Very healthy. But the monetization runway, that's still the major story. Today, only about 5% to 10% of users actually use the high-value features.
Like the debit card or the pay with Venmo option.
Exactly. The vast majority are still just using it for P2P, sending money to friends.
And for the accounts that do adopt those features, those higher value ones, the results are pretty staggering, right?
They really are. For that, engaged subset of accounts, the debit card users, the ones actually transacting with merchants, the average revenue per active account, ARPA, is something like 4 to 6 times higher than the accounts that only use P2P.
4 to 6 times higher.
Yeah. So they're currently only really monetizing a tiny sliver of that huge 66 million active user base effectively.
So how exactly do they plan to convert more of that, 90% of P2P only users into these high ARPA users? What's the tangible strategy there?
It seems like a multi-pronged approach. It's based around incentivization and ecosystem integration.
Okay.
They're using promotions, special features that make the wallet feel more integral to daily life. Things like linking Venmo directly into merchant loyalty programs or making the Venmo debit card feel maybe more like a lifestyle accessory than just a payment tool.
Right, making it cool.
Kinda. The goal is really to make Venmo the default spending choice for that younger demographic, not just the default way they send money to each other.
Got it. Now, beyond these current revenue drivers, we heard this term agentic commerce mentioned quite a bit in their calls. This sounds like maybe their biggest future-proofing initiative. What exactly is agentic commerce, and how does PayPal fit in?
Yeah, agentic commerce basically refers to this sort of generational shift where transactions are increasingly initiated or mediated by AI models or digital assistants, the agents.
Instead of the consumer manually clicking and filling out forms.
Exactly. Think about purchasing something via voice command to your smart speaker, or maybe an AI shopping bot that finds and orders products for you automatically based on your preferences.
So it's not just chatting with a bot, it's the bot actually making the purchase.
That's the idea. And PayPal is trying to position itself to be the, well, indispensable payment layer for that entire
Oh,
process,
right.
which is why these partnerships they announced are so crucial. They've got a major partnership with OpenAI to embed the digital wallet directly into ChatGPT.
For seamless purchasing right there.
Right. And they're also collaborating with Google and Perplexity.
And to help businesses cope with this shift, they launched something called Agentic Commerce Services.
Yeah, exactly. If you're a merchant, you probably don't want to build a custom payment integration for ChatGPT, and then another one for Google's AI, and another for Perplexity, right?
No, that sounds like a nightmare.
Right. So PayPal's agentic commerce services basically allow merchants one integration through their platform, and that gives them access to consumers across all these different emerging AI platforms.
So PayPal becomes the essential middleware.
Kind of. Connecting the AI agent and the actual financial transaction, it's a smart strategic position.
They're also working on optimization closer to home, too, right? Focusing on improving their core checkout flow.
Yeah, and even small changes can yield huge results at their scale. They mentioned the redesigned pay sheet. It's now deployed on close to 25% of their global branded traffic.
Okay.
And when they combine that redesigned sheet with biometric login, using passkeys or fingerprint ID, for example, in their internal testing, they're seeing conversion improvements between 2% and 5%.
2 to 5% lift just from that.
Yeah. And in a $458 billion TPV environment, even a 2% lift translates into massive dollar returns.
Okay, we can't talk about all this investment and optimism without acknowledging the stated headwinds, though. What risks did management actually call out that might temper some of this enthusiasm?
Right. Despite all the internal strength, management was actually quite candid about the external environment. They noted that these macroeconomic pressures are impacting consumer spending.
How so?
Specifically, things like basket sizes and average order value, AOV, are down. People are spending less per transaction.
Mm-hmm.
And they observed this trend continuing into October, which suggests, continued softness heading into the really critical holiday season.
And that leads directly into that high-stakes investment trade-off we sort of touched on earlier.
It does. To really win these big generational shifts, BNPL, Venmo Monetization, Agentic Commerce, the company explicitly stated they plan to increase spending.
More investment coming.
On product attachment, brand campaigns, AI initiatives throughout Q4 and carrying into 2026.
Yeah.
This is a very conscious trade-off they're making.
So they're basically telling you listening, that they are sacrificing some near-term margin expansion, maybe in 2026, for a chance to win the longer game in, say, 2028 and beyond.
That's exactly it.
Is that a risk investors should be worried about, or is it just a necessary strategic bet they have to make?
Well, management explicitly warned these investments may very well lead to some near-term headwinds in how fast transaction margin dollars and earnings grow in 2026. So they're being upfront about it.
Okay.
But I think it is a necessary strategic bet. They seem to be accepting a potentially slower earnings growth path next year because they believe if they don't capture this agentic commerce wave and solidify their BNPL scale now, they risk being bypassed later by faster competitors.
So it's a calculated move born out of confidence in their long-term position.
It seems that way. Supreme confidence, perhaps.
So wrapping this up then, what does this all mean for you, the listener? I think the takeaway seems pretty clear. PayPal is executing a very deliberate strategy here. They want to capture these major commerce shifts, digital wallets, BNPL, AI.
Right.
And this Q3 beat seems to confirm that the strategy is, at least for now, yielding accelerating profitable growth today.
Yeah. And that strategic commitment to invest now shown by the raised guidance, the first ever dividend, it really suggests management feels they're strong enough to take that calculated risk.
Mm-hmm.
They seem to believe the strength we see in the BNPL scale, the huge potential in Venmo monetization, and these key AI partnerships while that warrants sacrificing a bit of short-term margin growth.
Which sets up a really fascinating tension for the next year or so, doesn't it? We see this strong BNPL growth, massive upside in Venmo ARPA, these potentially groundbreaking AI partnerships promising future volume. But the company explicitly cited these current macroeconomic pressures hitting consumer basket sizes and maybe transaction volume. So the big question is, if this planned investment pays off, how quickly can the momentum from things like agentic commerce and BNPL overcome any continued macroeconomic softness?
And deliver that promised faster, durable growth.
Exactly. That's the high-stakes question for you to mull over as we head into the new year.